Welcome to another accounting lecture in which we're going to look at how we deal with changes in estimates. When we work with depreciation, it is not uncommon that a company may decide to change certain estimates based on new information that they've received or certain circumstances that have required them to make changes, such as, let's say, for instance, there could be an accident and the asset's life is reduced. There could be new information that tells you that the asset's life has increased. There could be a variety of reasons why a company may make these changes. So let's look at a quick example over here. We have a company that has purchased an asset for $60,000 in 2016. The original estimated life of the asset is 8 years, and the salvage value is estimated at that time to be $4,000 at the end of the life of the asset. Depreciation has already been entered for 5 years on this basis. In 2021, we decide that the total estimated life should be 10 years and salvage value should be $4,500. The company is using the straight line method. So we have two sets of information. One is before the change, obviously, and then is when we have the new information available. So let's start with the information that I have before the change. The original cost of the asset is $60,000. The estimated salvage value is $4,000. The life at this time we thought was going to be 8 years, and we're using the straight line method. Calculating depreciation expense in the straight line method is fairly straightforward. We have the original cost of the asset minus estimated salvage value divided by the estimated life of the asset. We have all the necessary information over here. So based on this, we calculate our depreciation expense to be $7,000 per year. 60,000 minus 4,000 divided by 8 gives me the $7,000 per year. Now in 2021, when I make the revisions in estimates, I need to find out what the book value of the asset is at this point of time. So I need to find out at December 31st, 2020, what the book value is. That's one day before the change in estimate has been made. And I'll explain to you why I need that information. This is fairly straightforward. Original cost minus accumulated depreciation gives me the carrying value or the book value of the asset. That $60,000 is the original cost. I got the number from here. I have depreciated the asset 5 times because I've used this information 5 times. So it's $7,000 per year multiplied by 5 is 35, leaving me with a carrying value or book value of $25,000. This is now the starting point for the assets depreciation moving forward when we make our changes. So the first part of the question, let me answer this. They've asked us, what corrections do I need to make to prior years? I make no corrections to prior years. So there is no entry required to make corrections to prior years. That's because we're not changing anything based on an error that we detected in the past. When we bought the asset, that was the best information we had, that the life is 8 years. The best information we had was that we probably could sell it for $4,000. So we don't change anything that happened in the past. It's only moving forward, which is why I needed this number, the carrying value. So now how do I calculate my depreciation? I need to first look at what revisions I've made. So I'm writing down that information over here. The first piece of revision is the life of the asset. Now I don't want the total life, what I'm revising it to from 8 to 10. What I want is the revised remaining life of the asset. So when I switch from 8 to 10 years, but 5 have already gone, I have 5 years remaining. Instead of 3, I'm saying I now have 5 years remaining in the life of the asset. Salvage value, I'm saying now is $4,500. So I have extended the life by 2 years, and I'm saying that I'm going to get another $500 when I sell the asset. That's my new guess. So I go through the same process over here, but with one difference, and I'll tell you what the difference is over here. The difference is in the numerator, instead of original cost, we have the carrying value at the date of change minus the revised salvage value divided by revised remaining life. I have all the information here, 25,000, 4,500, and 5 years. I plug those numbers in over here and I come up with a new depreciation expense of $4,100 per year. The accounts that I debit and credit stay the same. It's depreciation expense debit, accumulated depreciation credit. I now know the amount is $4,100. So once again, when we make changes in estimates, perfectly fine to do that. We don't change anything in the past. We make changes only moving forward. So changes in estimates are not uncommon. It's not done every time, but if it needs to be done, we do the changes in the current year and moving forward. That's called prospectively. We do not do any retrospective adjustment to the journal entries we've already done. It stays the way it is. So with that, we finish this exercise. In the next exercise, we're going to look at if there's a replacement, how it affects depreciation and changes.